Welcome back to the fundmonitors.com Meet the Manager series. Today I'm joined by Jonathan Wu, Executive Director at Premium China Funds Management. Premium China was started in 2005 and have grown to offer 4 actively managed specialist Asian equity and fixed income funds to both Australian and New Zealand investors. Their Premium Asia Fund, which was started in 2009, has returned 12.97% per annum since inception, outperforming the Asia Pacific ex-Japan benchmark by over 8% per annum. Jonathan, thanks for joining me.
Thanks, David.
In a recent 2021 outlook, the firm noted that this might be the year for normalisation. What do you think some of the key drivers for that are?
Yeah, I mean, our definition of normalization is effectively trying to get back to some level of 2019 normal, I guess, or at least have the world resemble something what we saw in 2019. Obviously, a big part of that is going to be vaccine deployment globally. The easy monetary conditions and stimulus policies, especially the latest round we're seeing in the US, which is going to be worth about 9.5% of GDP, that's going to be critical to finding some sort of level of normal. And obviously, we've also got round the US election from November last year. We've got a firm result on that. So at least policies that were promised could be potentially rolled out and hence a return sort of to normal life. Probably the last point as well is sort of Sino-US trade relations will probably get a little bit better under Biden compared to Trump, at least on the rhetoric basis. So I guess that's what we call normalization.
The growth of the middle class and urbanisation are themes in China that continue to drive their equity markets. Do you see that continuing despite COVID?
Yeah, I mean, especially with China, we've seen, and I guess broader North Asia, which we define as China, Hong Kong, Taiwan, and South Korea. I mean, they were basically the biggest beneficiaries from COVID because they were sort of first in, first out. To give you a bit of context with that, I mean, we've got 70 investment team members across the whole Asian region, and then obviously a larger concentration of those sit in Hong Kong as well as mainland China. By April, May-ish last year, we were already back on the ground in China doing physical company visits. And, you know, one of the things that we always profess that we do is that we try to achieve at least 6,500 company visits a year. Last year, we actually smashed that record. We actually did 8,600 company visits, of which half of those were very much focused on technology, consumption, which obviously is a massive driver to you know, a lot of the stock picks that we gained a lot of benefit from last year, as well as healthcare and education. So COVID, you know, wasn't a massive blip for China, first in, first out, and I guess the leader of the recovery this time, just like China was back in 2009. So that theme for us certainly hasn't changed. If we sort of look then at, you know, some of the things that are significantly growing within the Chinese market, is this shift from China itself being a supply chain economy. So supply chain effectively being a manufacturer to the world. Everyone has known that for a very long time. And probably one of the biggest impacts of that is that, especially in the last 20 years, China has been exporting deflation to the rest of the world. But now China's gone from being a supply chain country to being a demand chain. So instead of being pushed around and being ordered and being a price taker, China's now actually becoming a price maker. Okay. And one of the key reasons for that is they've gone up the value chain on manufacturing. They're looking at things that are more high precision, high tech, highly scalable. And, you know, these things are adding to the margins that are being generated in Chinese businesses to be higher. Therefore, you're going to have wage inflation, which is perfectly healthy in the developing economy. And then this rise in wages leads to a higher middle class, which at the moment is defined at about 400 million citizens of China as in that middle class. So these people are now tapping into things that, you know, we sort of take for granted. So one example would be duty-free shopping. So I think we can DFS and things like that in Australia, we can go and buy something duty-free and then subsequently we go overseas. So we don't have to, you know, spend our time in the airport doing the duty-free. So the whole market for duty-free in 2019, to provide that context, was about 82 billion US dollars. China accounted for 40% of that, of which then only 20% of that 40% was duty-free shopping done onshore in China. So we currently have a play in that space called China Tourism Duty-Free Group, or what we call CTG, in which we were waiting for their share price to sort of correct at a reasonable level for us to then enter. And we entered in sort of October last year, and we've made about 80% inclusive of these last few weeks. We've had the reflation play affecting equity markets. And these sort of themes continue longer term, and they're not things that we trade. These are things what we call structural. And so over the longer term, all of these have a long way to grow. And also what is very important to note is that they're all still trading at very attractive PEs compared to their Western counterparts.
You mentioned technology before. Asia's development in the financial technology space and its interaction with that middle class has been different to traditional Western markets. How do you think that journey is different, and how do you capitalize on that from an investment perspective?
Yeah. So as the rise of the middle class has happened, if we sort of contrast how the development of financial payment systems, more specifically, had developed in Western markets, what we have seen is that we've had a sort of a graduation from using purely cash to then going to using credit cards or debit cards or some form of card type payment system. But then from there, we then graduated to digital payment systems. So you could be thinking about things like Apple Pay or PayPal or things like that. In emerging nations like China or even India, for example, or Korea, they basically jumped a step. They went from cash, in which even that was sometimes hard to get a hold of because you don't have the geographical dispersion of banks available, bank branches across many of these emerging markets, to jumping directly to digital payments because everyone has a smartphone. And I think that's a critical thing to know. When you have a smartphone, it allows you to open up, your imagination as to how digitized you want your payment systems, how your transactions and how your daily life is spent, from gaming to consuming media to simply paying for things. So while we take it for granted now in Australia that you go to Coles or Woolies, you don't need to have your credit card and you just pay with your watch or whatever, in China, that's progressed at an extraordinary rate without having to have this intermediary of credit cards or things like that. And so for us, we've had long-term investments in things like Alibaba and Tencent is still our largest holding in the Asia Fund. And they have had astronomical runs through last year, going through a bit of correction now. But again, focusing on the fact that these are structural long-term changes, it doesn't change our investment thesis.
Before we press record on this interview, we were talking briefly about the income fund. And you offer an Asian income fund. Given that Asian credit markets are probably not on the radar for a lot of Aussie investors, why do you think that this asset class is one that more people should be looking at?
Yeah, so it is a very unique asset class from an Australian investor's perspective. Traditionally, if you consider, bond strategies that you invest into, you generally fall into two buckets. You fall into investment grade, which a lot of the time is invested in government debt or sovereign debt. And then you've got high yield, which is generally corporate credit. So in 2011, we launched a strategy, and from day one, our aim hasn't changed till now, almost 10 years into 2021. We're trying to achieve a diversified range of corporate debt across Asia, both sovereign and corporate credit, and we're trying to achieve a 6% distributable yield out to investors per year, paid on a quarterly basis. Now, we've had that fund now running for 9.5 years. Our family seeded the fund with $4 million, and actually in the last 12 months, we've topped that up to over $5 million. And what we're trying to do is effectively, in that 38 observable quarters in the history of the fund, we have never failed to pay less than 1.5%. But it's a little bit more than just the yield that is very important, especially in the current market. So if I share with you what a standard Australian government and semi-government bond strategy would do for you, this is just an index type strategy. It is marketed to an investor that will pay you 3% distributable yield. And that's true. That's not a lie. It's not misleading. But there's another very important factor when you consider what you try to generate for investors in yield, and that's called the yield to maturity. Okay. So whether it be on an equity side or buying corporate credit, we're trying to buy bonds that are trading on the market less than $100. Okay, because we want to pick up a little bit of capital gains for investors. So in that same Australian government and semi-government bond strategy, what investors are currently sort of achieving is a cash yield of around 3%, and then a yield to maturity of 0.7% with a maturity profile of about 6 years. So what that means is that if you hold this portfolio of Australian government debt and semi-government debt for the next sort of 6 years, you'll get 6%, you get 3% a year in income distribution, but then at the same time, you're going to lose 2.3% capital loss. So Damon, what that means is I'm effectively saying, here's a great investment today that I'm going to sell you a whole bunch of bonds for $115. And in 6 years' time, I guarantee you, assuming the government doesn't collapse, I'll give you $100 back. Mm. We are on the opposite side of that. So our cash yield is not 3, it is actually 7.32, but that's not the important point. The important point is the yield to maturity, which we are just sitting at slightly above 8% with a maturity profile of the portfolio at about just under 3 years. Yeah. So in actual fact, on average, out of all the bonds that we hold, we are paying $97.50. And if we hold all these bonds through to maturity in about 3 years' time, you'll get $100. That's a good investment, not guaranteeing capital loss for investors. So that's something that, has driven a lot of interest, especially as, risk-free rates and term deposit rates keep falling. To today, what is the term deposit rate for 12 months? Probably 0.4.
Yeah, it's having a conversation with my in-laws who are totally dependent on income from term deposits last night about exactly that situation. Jonathan, as always, great to talk to you. Good luck for 2021, and we can only hope for normalisation after what's been a pretty tumultuous 2020. Thanks for joining me today, and good luck.
Thanks, mate.